a little bit more time for folks to settle in. So we'll be back in a minute. Hi, everyone. So welcome to New England Winter Power Market webinar for winter 2014-2015. Your host is me, Natalia Misverishvili. I'm a director for New York, New England desk, and I'm joined here by Rick Margolin. He's our senior natural gas analyst over in Boulder, and he will jump in the beginning of the presentation and just go through a couple of slides regarding gas. I'm also here with Patrick Higgins. He's our demand analyst, so if you have any questions at the end of the presentation, he'll be here to answer. Again, if you have questions, please type in to go to webinar. Some of the slides are actually a little bit text heavy. You will get the slides and recording after the presentation later on today. So if anybody has any further questions after going through them, don't hesitate to reach out, email us, call us, or IM us. So without further ado, I'll just jump in. So the main agenda is we're going to go through briefly current state of New England power market, jump into our forecast for the winter 2014-2015. Look at the winter reliability program by New England ISO, so the effect of oil and LNGs that are going to come into play this winter. And the biggest one, look at the generation retirements of Vermont Yankee and other non-gas-fired generators this year. So just a quick overview. New England is faced with your typical economic problem of demand and supply. So you have the demand for gas from your power generators, and you have demand from the LDCs, your residential and commercial demand. So residential and commercial demand has been growing in the past couple of years, squeezing out power from getting that gas. On the supply side, we have our gas pipelines that are set. The Rescon gets gas first before the power, just because they have firm capacity. And generators are pretty much unwilling to sign the contracts, just because we don't have volatile gas prices throughout the year. They're mainly volatile during the winter or during major pipeline maintenance. So static supply and increasing residential and commercial loads results in scarcity of gas and spot gas price volatility. Same applies to your LNGs. As you know, throughout the year, LNGs in Asia and Europe are more competitive compared to prices in US. So that this kind of lack of price incentive leaves New England short of LNGs. On capacity market side, we've been pretty much clearing at the floor 3 kilowatts per month due to surplus supply. And recent changes and recent generation retirements has pushed the capacity market clearing close to 15 kilowatts per month, but that's not going to come to effect until 2017, 2018. New England ISO has implemented some regulatory changes. So what we're going to see this winter, we're going to see introduction of hourly bidding, and we're also going to see increase in penalty factors. So that's to improve performance of operating reserves. So the state of the market is your supply and demand issue with limited supply and increasing demand. Jumping into winter demand and weather forecast, just a quick overview of what happened last year. We had pretty cold winters. Everybody remembers below seasonal temperatures pretty much throughout New England. Western Massachusetts and Connecticut were coldest in Feb. Maine coldest in December. Significant event was polar vortex. So looking at this winter, so I think general market consensus is that it's going to be a cold winter. Our Mets over on Genscape side, we agree in general overall with that consensus, but we do think that December is going to start out mild. We're going to have seasonal, slightly above average temperatures for December, and then it's going to get progressively colder. So definitely look for colder January and even colder February 2015. Even 3 to 4 degrees below average. So we're going to see those teens temperatures over in February. This is just a graphic summarizing heating degree days, December, Jan, Feb. And just to drive the point across again, we're definitely mobiled up on January and February going forward. So I'm going to pass it over to Rick to go through his slides over on the gas side.
Thank you, Natalia. Yeah, so in the gas market, on the gas side of the market, we've seen some really interesting volatility in the past 2 winters. Volatility in the Algonquin market is nothing new. It's a constrained market, and it's been constrained for many, many years. However, as you can see on the chart, the volatility and the price blowouts have achieved a greater magnitude the past 2 winters relative to the previous winters. People's first reaction is to say, well, the last year's price spikes were simply a function of the extremely cold weather, but we don't believe that that explains the entirety of the price blowouts last winter, nor does it explain why prices began blowing out to greater levels in the winter prior. So if we look at the next slide, what we see is the relative temperatures in the Algonquin market. And as represented by the black dots, we can certainly see that last winter was on the colder end of what winters look like in this market. However, the variation of temperatures last winter were not necessarily that extreme, not extreme enough alone to explain the price blowouts. In addition, we see those price blowouts started to manifest themselves in the prior winter. And if you look at the diamonds on this chart, or the trend line associated with that, you'll see that that was actually a relatively warm winter. You can also see in the lower right corner of this chart the deviation from normal of temperatures the last 2 winters relative to the previous winters. So the point here is that temperatures were really cold last year, but not extremely so in the context of this market. So if temperatures can't explain why prices the last 2 winters are blowing out, what do we think is happening? On the next slide, what you can see is Rescon Demand, which at Genscape we label Citygate. And this is demand on a population-weighted basis by degree. So demand per degree on a population-weighted basis. And what we see is a steady upward trend. So in other words, at fixed temperatures every single year, the Rescon portion of the Algonquin market is consuming more and more molecules of gas. This is really interesting because, as noted, the Algonquin market is constrained. So what this means is the only way that you can grow demand in one particular sector of demand is by pushing out another demand source. And as we see on the next slide, the effects of this are such that power is the source of demand that is appearing to get pushed out. I believe if we advance the slide one click, what you can see here is that this trend is particularly pronounced at the colder ends of the temperature spectrum. In other words, when temperatures in the Algonquin market get really cold, Rescon basically is getting first dibs on gas and pushing power out, and it's doing this by virtue of pricing power out of the market. And when Rescon has to price power out of the market, we start to see these bigger price blowouts. Basically, Rescon has to bid up the price high enough to compel power producers to throw up their hands and say, you know what, we are not going to consume gas. We're going to go ahead and make the switch over to fuel oil. If we advance to the next slide, what this shows is that this Rescon versus power battle really starts to demonstrate itself when total demand in the market, in the Algonquin market, crests 1.6 BCF per day. When demand begins to break that 1.6 BCF per day level, then what we see is Rescon begins to grab a greater portion of the total demand, and power demand for gas begins to narrow. So what does all this mean for this winter from the gas perspective? Here we see total Rescom or Citygate demand on a non-weather adjusted basis in the Algonquin market. And what you can see is that it's generally been trending upwards, although in some years it does decline, and that really demonstrates the fact that the general upward trend is driven by Rescom. It's driven by that structural shift of new consumers connecting to gas lines, abandoning fuel oil for home heating in favor of gas for home heating. However, because gas is being used for heating, what that means is the market is still really sensitive and exposed to the volatility in weather. If weather does not show up, we actually do see demand decline. But when weather does show up, as it did last winter, we can see pretty significant demand growth. So what we're seeing here in the solid green bars is total Rescon demand in the market. And at the top of each column is the change relative to the previous winter. So respecting the fact that we believe that there are structural shifts occurring in the Rescom sector, what we tried to do was project demand this winter under a variety of different weather scenarios. And the first shaded column shows what we expect demand will be in the Algonquin market for the residential commercial sector if temperatures this year are considered to be within quote-unquote normal. And by normal, we are using 10-year normals. So if temperatures in Algonquin this year are normal by 10-year standards, then we would reasonably expect to lose really only about 0.04 BCF per day of demand. So it's actually really not that much of a loss if we get normal temperatures relative to last year. And it's not that much of a loss because there is that upward growth in Rescom by virtue of pushing power out of the market. The next column, the second from the right, shows what Rescon demand would be if temperatures this winter look exactly like they were last winter. If that happens, and in light of the fact that there is a structural shift in the Rescom market, we could reasonably expect to add about 160 MMCF per day of Rescom demand above what that sector consumed during last year's extremely cold winter. So if temperatures do get really cold, there will be even more Rescom demand. And in order to facilitate that, Rescom sector has to bid prices up in order to push power demand out in order to secure a limited supply of molecules into the market. But one of the themes that we are really trying to impress upon our clients is that it wasn't that long ago, it was winter of 11-12, where temperatures, not just in Algonquin, but throughout the U.S. market, were extremely warm. They were as much to the warm side as last winter was to the cold side. So if we make sure that we don't let our memories be so short that we only fixate on last winter's extreme cold, and we apply those temperatures that we saw in 11-12 to the demand trends that we're seeing in this market, you could be shaving off about 0.4 BCF per day of demand. Realistically, we believe that things are going to come in more close to the normal temperatures, maybe slightly colder than normal, as Natalia mentioned. But all of this demonstrates that there is significant Rescon growth, and the only way that Rescon growth can be facilitated is by pricing power out of the market. So with that, I'll go ahead and pass it back to Natalia.
Thanks, Rick. All right, so we'll jump into oil and LNG in New England. So like last year, New England ICE is introducing winter reliability program. So they're increasing incentive for oil generators to procure oil, and what they said that they'll compensate for any unburnt oil inventories at $18 per barrel. So they're requesting participation of over 4 million barrels compared to over 3.5 million barrels last year. So it's a definite increase. One other big thing that's different from last year is that there's new LNG incentive. Similar, any compensation for unburnt inventories is at $3 per MMBTU, and they're requesting 1.52 BCF. They've also requested the dual-fired generators to demonstrate the capability of switching, just because we had a problem last year looking at some data, just overall the emissions, they wanted the capability of a generator switch from gas to oil was not that efficient. And winter reliability program is open to demand response, assuming that our new assets are not participating in wholesale or currently participating in forward market. So overall, regulatory rule changes have increased the capability of the system to respond to strained conditions. So on the LNG side, the district gas LNG terminal at Everett can meet as much as 40% of New England natural gas supply at peak demand, and that's according to GDF Suez. Everett terminal itself directly connects to AGT, TGP pipeline, National Grid local distribution system, and fits straight into the Mystic Power Station, which I'll cover later in the presentation. From recent news and just looking overall what we gathered, GDF Suez has purchased over 475 MMCF since July to November, with the option to buy same amount during the period from Gas Metro, a Canadian-based company. So over on Genscape side, we do monitor the cargoes and LNG cargoes coming in Canonport and Everett and how much gets into the gas pipelines. What we've added recently is we monitor the trucks leaving the Everett and just going into the LNG storage areas. What we've been seeing for the past couple of weeks, we've been seeing 2-3 trucks a day. That's equivalent 30,000 to 40,000 MCF a day leaving Everett station. So all this information we will be monitoring over the winter months, and it's available for you if you would like to look at it. Another thing that we've noticed is that they've been testing outside of Boston accelerate regasification barge, which basically regasifies the LNGs, and that has been tested in the past month or so. So they're trying to get ready for the winter months. On the oil side, so on the oil side, it's been trading, last time I checked, 35 cents lower per gallon, and that's the lowest compared to the 5-year average, and that's due to the surplus. We are much lower on oil prices this year versus last year. The two things to look out for going into the winter is the OPEC meeting on November 23rd, and that's they're going to basically come to a consensus if they're going to decrease the production or keep it at the same level. Market consensus is that the OPEC is not going to decrease the production, just because for them the main thing is to keep the long-term objective of keep the market share versus the short-term profitability. So the consensus is that oil prices will continue to decline throughout the winter. The other thing to look for is price fluctuation-wise is the demand in Europe, which we'll cover in this next slide, is how cold European winter is going to be and what they're going to draw out. So oil was in the margin in New England came in pretty fast once the gas started trading high. We think at those current oil prices, the switching to oil from gas is going to occur at the lower threshold this year. Over in Jetscape, we do monitor New York Harbor storage numbers. So again, we'll be monitoring this throughout the year. We'll probably have close to a year worth of data. So that's something that we can definitely provide and we'll be keeping an eye on. So just looking at a quick outlook on the winter for Europe, it's supposed to be a mild winter over in Europe, so we do expect less demand on oil from UK as well as Germany as well as on LNG. And that means if we need those cargoes, they'll be easily diverted from Europe into US. So let's jump into the last portion of our presentation, which is the retirement of Vermont Yankee and other non-gas-fired generators. So one big thing we have is Vermont Yankee 604 megawatts nuclear unit is coming offline. It's on coast down period, and it should shut off completely by the end of December. That accounts for approximately 70% of electricity generated in Vermont, which is, from Vermont's perspective, we don't have that much load, but for overall New England, it's a significant impact. On top of it, we did lose Salem Harbor. It's 749 megawatts, retired this summer. That's 4 units of coal and oil. Mystic. So the fact that we are going to have a pretty robust supply and storage of LNG will help out Mystic to run compared to last year. Mystic has captive LNG. It provides 30% of Greater Boston power. It can generate up to over 2 gigs. And just quick information just on Mystic overall. Just to have one of the units at 740 megawatts run, they need to burn probably over 100,000 MMBTUs. Last winter, we just took an output on Mystic for January and February. I didn't exclude weekends, just overall what's an average runtime. And January, they ran closer to 8097 megawatts, and February around 687 megs. We do have gas burn data on them as well, so we are monitoring that side. So what we did is that we grabbed 2 supply stacks. We grabbed supply stack, last year's supply stack at I think 19.8 gigs. Took out Vermont Yankee just because there's so many variables stay over year over year. So on top left you see last year's supply stack without Vermont Yankee, with 1 Mystic running, with old oil pricing. And we ran the same supply stack without Vermont Yankee, with 1 Mystic, with lower oil pricing. And we saw the drop, and the gas was at that point trading at $34. So what we saw a drop in LMPs from 255.16 close to 248. And then we saw, if you can see here, we saw more concentration and faster switching to oil than last year. So oil started coming in below $140. So we expect oil to start coming in at lower threshold this year. Because they're testing the gas to oil switching, we think this middle portion of the supply stack here is going to be more heavily oil traded, oil generation, and just overall slightly lower LMPs compared to last year. Also put just a quick look at temps versus gas, at what temperatures we saw the gas blowout. And as everybody remembers, so $80 on AGT, we have those, the moment the temps reach below teens, so 9-8 degrees, you see this sharp increase in load. And we also graphed it against the demand. This is our day-ahead demand clears that came in. So we start seeing this blowout when we start going over 21.5 gigs. So just to summarize, so we have a couple of factors that change last winter versus this winter. We have first factor, non-gas power supply. That's pretty bullish. We have Vermont Yankee retiring nuclear unit baseload. We have Salem Harbor, which ran a little bit last year. So that has a pretty bullish impact. Oil prices, they're trading 20% lower than 2014. That's bearish. LNG storage. We have LNG more storage this year than last year. So, and just looking at the LNG prices at Japan Korean medium for summer and the fall, they were trading closer to 14, 15 per MMBTU. So this is the assumption that we're going for, that this is at the prices that will contract at. Regulatory rules. We have hourly bidding, greater penalties, and more fuel storage. So that's bearish. Pipeline supply, we're saying the same. It's neutral. Weather-wise, we're pretty much the same, except for mild December and pretty cold January, February. So that overall has a neutral effect. With the Rescon demand, we have slightly bullish just because we anticipate February to be really cold, with increasing, with dropping temperatures in January. So that puts us on the slightly bullish side of things. So that pretty much concludes the webinar. Just going to stay on the line for a little bit to see if anybody has questions. Again, we'll email those slides, and if you would like to get back to us, definitely do. And also, if you have different scenarios that you would like us to run at different oil prices or LNG prices with our model, that's something we can do on individual client basis. Thank you very much. We had one question regarding DFO demand this year versus last year and what we think is going to get traded, possibly slightly at the premium, just looking at the fact that there were regulatory changes at which ships this year are required to burn low sulfur, so switch to DFO at a certain distance from the shore. So there may be some increase in demand over there and a bit of a premium on the pricing. So that's pretty much it. Please email any questions if you have, and I'll email the slides to everyone as well as the recording. Thanks for joining us.